This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Well, hello, this is Hall Martin with Investor Connect. Today we're here with David Wadler, angel investor. David, thank you for joining us.
Hey, it's my pleasure to be here.
So what was your background before investing in early stage companies? What did you do before you started angel investing?
Well, I often joke my 20s were a lost decade. I sort of gallivanted around the world a bit and job to job, didn't really know what I wanted to do, and decided ultimately to become an entrepreneur. And that experience as an entrepreneur financially put me in a position to be an angel investor. But as importantly, I think I developed a ton of empathy for what startup founders and operators go through, which has really informed the way I think about angel investing as well.
Great. So what excites you right now?
So I would say that broadly, it's never been, well, maybe until the last few weeks, it's never been historically a better time to be an investor and to be a startup person. I think, again, when we planned this, we were living in a different world pre-coronavirus. But if I put on sort of my glasses from that time, there's a ton of liquidity, there's lots of innovation, and it has really never been easier in many respects to start a company. Low cost access to technology, the ability to leverage distributed teams, which basically gives you access to talent in markets that historically would have been off limits to you, changes in the way supply chain works. Fortunately and unfortunately, some of this is being tested by what we're dealing with now with this pandemic.
Absolutely. It's a brave new world here. We'll see how these things play out in the near future. In the meantime, you deal a lot with investing in startups. What's your advice for those people who are just now starting to invest in early stage companies? What do you advise them to do before they write that first check?
Yeah, so I think the first thing to do is to think of it as an investment. For some reason, and particularly this seems to be the case in technology startups, once somebody reaches a level where they can do investing, there just seems to be this real strong desire to put money to work. And that doesn't necessarily mean put the money to work smartly. It just means, people want to say, oh, I'm an angel investor. I put money into this startup. And it doesn't even necessarily seem to be about cocktail party cachet as much as it is sort of an excitement and an enthusiasm to be part of a young idea and company. And so I typically advise people to pump the brakes and to look at a bunch of stuff before they pull the trigger and sort of proceed with the expectation you get a deal put in front of you. As excited as you are, just tell the founder, look, I'm going to go through this process deliberately. And if it's something that you are serious about in terms of becoming an angel investor and doing it more than once, because, look, people do one-off, I would say, hey, find something you like and do something with it and cross your fingers, right? It's a lottery ticket. But if it is something you're going to want to do, you're going to want to ultimately build a more diverse portfolio. And so I would typically will tell people to look at a bunch of deals before they put any money to work.
That's a good point. Diversification is very important, and having a good broad perspective is also important too. So on the other side of that table, what's your advice for people running startups? What do you tell them to do before they launch that company and go raise funding?
Yeah, so I do about probably 2 to 3 calls with entrepreneurs every week, usually between 9 and 10 p.m. my time. And in fact, I had one with the company last night, and they had scheduled the call a few weeks prior. And by the time I spoke to them, they had actually shifted from we're going to raise money to we're going to go figure out how to generate some revenue. And I think, again, given the climate that we now find ourselves in, that's probably the right idea. But that's a specific example. I would say more broadly that founders and operators of startups need to look at investors and convey 2 things. One is like, what is the upside, right? And If the upside is there, it means that you have a large addressable market, you're meeting a real need, and all that other stuff. And if all those things play out, right, this is what the lottery ticket could be. But the other part of that is really mitigating the risk. And I think this is especially difficult for first-time founders. When I did my first company, it took me 2.5 years to raise $1. When I did my second company, after an exit of the first, I sent out a bunch of emails when I was interested in raising money, and a lot of people just wrote me back and said, how much would you like? It's not always going to be that easy, but it was a profoundly different experience. So when you are going out there the first time, how can you mitigate all the different risks? So one risk is I'm a first-time founder. I've never done this before. And for me, raises some questions about how dedicated is this person? How adaptable is this person? How creative is this person? How good is this person at hiring people? How good is this person at selling, etc.? And then there are other risks, right? So I've talked to a variety of companies. I spoke to one last week. They said, oh, we have 700 users. I said, okay, and you're selling to users, not to businesses. Great. What is the business model? I said, well, we want to make $99 per user per month. I said, great. How many of them are paying for it? None. I said, how long have they been using it? About a year. I said, so a year in, you have not proven to me that you can get people to part with their money if you ask them for their money. No. So for something like that, again, they're going to have mitigated one risk. Can you deliver a product? All right, check. Can you get people to adopt that product? Check. And in this case, can you get people to buy that product? Maybe, maybe not. And there are going to be different levels of risk along the way. And they get people to buy it. Then the next question is, can you do a proper go-to-market? Then if you can do a proper go-to-market, can you scale? And ultimately, those questions are going to change depending on the stage of investment, right? So the threshold for a pre-seed or a seed investor in terms of risk mitigation should be lower than it is for like a Series C investor. Having said that, I think that founders need to put themselves in the shoes of the investors and really try to look at it from that perspective. Like, why you? How do I know this is all going to be okay, even if things go sideways for a bit?
Well, that's a good point. So you've been an angel investor for a while. How do you see the industry evolving for startup investing? What changes do you see coming up?
Well, there's been obviously a seismic shift with crowdfunding. The government, in many respects, with qualified and accredited investor thresholds, has tried to keep people from making decisions that could harm themselves financially, which in many respects doesn't make sense to me, because you can go put all your money into a penny stock or even a larger company. And I guess there's SEC regulatory threshold that these companies need to clear, but you're still going to be putting your money at risk. And with crowdfunding, it has opened up angel investing to many more people. And we talked earlier about diversification. And I think that even for investors who are not typically involved in crowdfunding, it may, and I don't actually do this myself, but it is something that I'm thinking about, it may make sense to latch on in some respects, like with a part of the money that you've set aside for angel investing with a syndicate, for example, that's going to give you broad exposure. So if you say, I'm going to take 20% of my money, I'm going to put it with a syndicate who goes out and sources deals, and I think that this person is a good person to lead the syndicate, that could be interesting. But I think the biggest change is crowdfunding. I think the change that's on the horizon is basically the big unknown. I think we're going to see tons of challenges around liquidity. And I would not be surprised if creative and we begin to see alternate kinds of financing. But time will tell.
Very good. So what is your investment thesis for investing in startups?
Well, I would say my number one thing is probably jockey over horse. And what I mean by that is I am much more inclined to put money into a really good entrepreneur who hasn't figured out his business or market yet than I am for somebody who can say, all right, I have all these things figured out, but I have lots of questions about that person. Now, ultimately, you'd like these things to line up, but that is the number one thing. Secondarily, if at all possible, I would like to be able to provide value beyond my check. And I think there are certain general business areas where I can offer a voice. And again, I'm aware that these founders and operators are hearing lots of different opinions, and mine is just one, and it doesn't necessarily mean it's right. But if I can at least be a sounding board, that's helpful. And it makes me more inclined to invest. And that's probably why I invest. I definitely have a tilt towards B2B software because that's my experience. And that's where I feel like I can provide the most data-backed guidance. But again, that doesn't exclude other companies from being considered.
Can you talk about one or two startups that fit that thesis that you funded?
Sure. Actually, I think there are two that are probably particularly interesting because they're so similar and dissimilar at the same time. So I was approached by someone named Raj Dutt, who is the CEO of Grafana Labs, Grafana, not PH. And I've known Raj for probably 10 years. Our previous businesses had worked together. I had subletted some office space from him for a while, and we had become friends. And he watched me suffer and ultimately succeed. I watched him suffer and ultimately succeed. And we built a great relationship inside and outside of the work environment. And Raj had this idea to take this Grafana project, which was at the time an open source visualization package, and turn it into a business. And I had basically no idea how he was going to do that. I had loads and loads of concerns about it. And I would ask him, and he would give me his best guess. And many times he'd just say, I don't know. What do you think I should do? But ultimately, I was making a bet that he could figure it out because I've seen him do it before. It took years and years and years of, I put money into the company multiple times. They had multiple friends and family rounds, ultimately raising a couple $1 million that way, more than a couple $1 million that way. But they couldn't get institutional capital. And he did figure it out. And they had a round led by Lightspeed. I think they announced it Q4, but I think it was closed Q3 of last year. And they raised over $20 million in that round. So again, in this case, my faith was borne out. That doesn't mean that I need to have a 10-year relationship with you, right? To believe in you. There's another company called Guru. And again, potential spelling issue with all these companies that begin with G. That's Gooroo. And it is a marketplace that connects tutors with students. And I am not an ed tech expert. It is a B2C business. It's actually a marketplace. I don't have a ton of expertise in either of those domains, but I know some people in the space. And the founder was just unbelievably persistent without being annoying. And he asked me for money. I said, it's not something that I really know about. So he asked me for advice and I gave it to him. And he kept the lines of communication open and continued to give him my 2 cents over and over. And what I noticed was over time, he started building out this incredibly impressive list of angel investors, soft circling their money as he went. And I said, how are you getting access to all these people? And he was just an absolute kind, polite, genteel pit bull. And he just kept pushing and pushing and pushing and pushing. And ultimately, I said, I'm super impressed that you've been able to put together this roster. And it wasn't just that I felt more comfortable investing alongside these people, but I felt really more comfortable that I was dealing with someone who wasn't just going to roll over when he heard no. And he would push, because you're going to have a lot of no's in a startup. And so he was able to show me that he could deal with no, and in many cases turn no into yes. And ultimately, right, kind of a self-fulfilling prophecy, my no turned into a yes. I became an investor in that business.
That's a great example of perseverance, which is a key aspect of a good entrepreneur. So what are the challenges in this space for the startup? You see a lot of startups out there. What do you think are the top 1 or 2 things that they struggle with?
Yeah, I would say a lot of it just has to do with the natural conflict of being in a startup. In a sense, it's like a religion. You take things on faith. And if you don't really, really, really believe in the startup, there's no way you would leave a regular job to do it. It is a masochistic experience. It is really hard. Yes, the highs are really high, but the lows are really low. When I got engaged, it was during my first startup, and I had to call my in-laws and ask for their blessing. And the conversation began with, I realize I haven't had any income in 2 years, but, right? That is not the way you want to begin that discussion. But that was my reality. And so in order to do that, I had to be really 100% committed, not just to the business, but to the idea of the business and the idea that this business was going to succeed and it was going to address a need in the market. But the problem is that you're not in the business of necessarily converting people, right? Like in a religion, when you're out there raising money. You do want them to believe, but you need to provide something beyond sort of like faith. And this is what I was talking about with risk mitigation, the ability to put yourself in someone else's shoes and look at your own business with skeptical eyes and figure out, all right, what can I do to mitigate that skepticism? I think that's probably the most important thing. And everything kind of flows from there, right? Once you can step outside yourself and look at your business to the extent you can as a third-party observer, you can begin to poke holes in it and then figure out how best to fill those holes. So when you do go out to raise money, those are no longer objections.
That's a good point. So you see a lot of different applications out there. If you had to pick one or two that are good immediate opportunities for investors to pursue, what would you put at the top of the list today?
Well, again, I would say I certainly have a B2B software inclination. I think products and services that support data science and machine learning are very interesting. We've made a ton of progress. We, meaning like the technology business, has made a ton of progress in the last just 3-4 years even. There are tools now that allow people to do by themselves things that 10 years ago would have required a team of PhDs to do. And you can get this through subscription services. But we are really still in the very, very early days of machine learning and data science. And I think we're going to see some pretty significant compounding growth in that space. So that's probably an area of significant interest to me. Another area, not an area where I've had a lot of experience, but energy and energy storage. We've seen the market for solar has completely changed. Google has sort of had a project spin out, which has changed the financial equation for geothermal heating and cooling. Wind is everywhere. And the way we think about the grid is different. I mean, if I had told you 10 years ago that there'd be a sizable contingent of Americans who are selling electricity back to their energy provider, you probably would have looked at me like I was crazy. So I think there's a lot going on there. And I also think it is a really compelling do well by doing good opportunity. Right? The climate change is an existential threat in most respects to me, and probably all respects to me. It is scarier than the coronavirus pandemic. And so if you have the opportunity to do good for the planet and make money while doing it, that sounds also pretty appealing to me.
Well, I agree. I think that's going to be a key place for venture capital to bring its skills and resources to bear. In the last few minutes that we have here today, what else should we cover that we haven't?
I think we're pretty good. Again, I think there's a lot of uncertainty in the world. Maybe this is actually a good place to go with this. There is a lot of uncertainty in the world, and there always is. The different coronaviruses have existed for millions of years. This one just happened to ultimately cross over from animal to human. We are going to experience a pretty profound recession, potentially a depression. But that doesn't mean innovation goes away. In fact, I think during these times when resources are scarce, people get more creative. I think as angel investors go, if you have liquidity, the next 6 months, year, 2 years are going to be really, really interesting opportunities for businesses that could potentially transformational and probably the valuations are going to be much more reasonable than they have been. So, look, I don't want to be Pollyannish about this. I think we're in for a long haul with the coronavirus, but there is a silver lining, and we will, as a society, as a planet, bounce back from this. And in so doing, we can avail ourselves of opportunities and put entrepreneurs in a position to change the world for the better. Let's do that.
That's great. It reminds me of the old angel manifesto, which says angels want to do a little good, have a little fun, and make a little money. And if you miss any of those components, I don't think you're getting the full experience. So I was glad to see you bringing those things up in this discussion today.
That's great. I'm going to take that with me. I actually hadn't heard that, so I'm going to use it from now on, if you don't mind.
You bet. You bet. Okay. Well, great. Well, how best for listeners to get back in touch with you?
Yeah. So I am not just an angel investor. I am a masochistic entrepreneur. So doing it again. So my company, as you mentioned, is Vendorful, and David at Vendorful.com is an easy way to catch me.
Great. We'll put that in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
All right. Thanks so much for your time, Paul.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinions of Investor Connect. This podcast is for informational purposes only and should not be relied upon for the basis of investment decisions.